Hello everyone, welcome to another video of CFA Level 1. In today's video, we will be starting with return models. Okay, so in risk and return part 2, we have a couple of return models. Some of them are based on total risk, some of them are based on systematic risk. So when we talk about total risk, it considers both systematic and unsystematic risk. So we are talking in terms of sigma, and when we are talking about returns based on systematic risk, we are considering returns which are based on beta. Okay, and then there are some other models in return which are dependent on specific factors, right? Specific factors or specific risk and the returns based out of it. Okay, so having this background, let us start. First is the return generating model, and don't worry, guys, these are very small topic. There is only one major and big topic known as capital asset pricing model, and as of now, we are not looking at it. But when we will start, I'll give you a heads up that this model is very important in terms of exam, not only in terms of exam, but also building the concepts for future, uh, you know, future studies that we will be doing. Okay. First is return generating model. What is return generating model? It is a model that provides an estimate of the expected return of risky security given that certain parameters or factors are. So basically what it is saying, it is providing me the expected return. It is giving me the expected return where the risk, okay, is based on three primary factors. Okay, and these, what are the three primary factors? First is macroeconomic, second is fundamental, third is statistic. Okay, very theoretical topic. Most of the time, gets ignored and is never tested. And just a small thing. Okay, then we come to multi-factor model. This is important. Okay, so this is an important topic. So you can expect a numerical in it as well, or you can expect a theory on this as well. Okay, and it can also help you to build some base over your existing knowledge. Okay, multi-factor model, it allows more than one variable to be considered in estimating the return and can be built using different kind of factors such as macroeconomic, GDP growth, inflation, or consumer confidence, fundamental factors like earnings, earning growth, firm size, research expenditure. Okay, so what we are saying is that it is saying that return. So in the single index model, in the return generating model, it was saying that returns are based on the three primary factors that are macroeconomic, fundamental, and statistical. In the multi-factor model, it is saying that return is based on multiple factors. Okay. Now these multiple factors can be earnings, can be geopolitics, can be macros, so on and so forth. Okay. So general form of a multi-factor model with K factors. What is K factor over here? K factor is any number of factor. Any number of factor. Okay. What is K factor? K factor means any number of factor. Okay. What is it? ERI. What is ERI? It is expected return on security. Expected return on security minus RF. What is RF? Guys, we have all seen what is RF. Guys, we have seen what is RF. RF is nothing but risk-free return. So, what do we get? When we are writing a term like expected return on security, minus risk-free return. What do we get? It is equal to risk premium. Guys, please note it. This is a very important concept. You should write it down. When expected return of security is deducted from the risk-free return, what we get is risk premium. Okay. So this entire term that we are seeing is nothing but risk premium. What is it? It is showing the beta. What is beta? Beta is a measure of risk. We have also already seen. Beta is a measure of risk into the returns from this risk. From this risk plus beta B. What is beta B? Another risk factor into return from the specific risk factor. Guys, you are understanding. So what we are doing is that in a multi-factor model, what we are saying that the security returns are based on multiple risk factors. Okay, and what we are doing is that we are assigning a numerical measure to each of the risk factor and we are multiplying it with the expected return because of that risk factor. Okay, so what we can do or what we can say is basically suppose if the risk factor is earnings, okay, earnings, second is growth, third is macroeconomic, fourth is competition. Okay, if we are assigning the beta of earning as 1.1, growth beta we can assign as 1.2, macroeconomic beta we can assign as 0.8 and competition we can assign as 2. Okay, and we say that the expected return based on each beta is, for example, for earnings the expected return is 0.5, for growth suppose it is 0.8, for macroeconomics it is 1, for competition for example it is 0.9. Then we can say that risk premium is nothing but earnings beta into the return plus beta of growth into return plus beta of macroeconomic into return plus beta of competition into return. Okay, which is nothing but 1.1 into 0.5 plus 1.2 into 0.8 plus 0.8 into 1 plus 2 into 0.9. Are we getting it? So here we get 0.55 plus 0.96 plus 0.8 plus 1.8. So we can say that the risk premium is nothing but 2.6, 2.6, 3.6, 3.54. Sorry, 3.56. Risk premium is 4.11. If we assume that the risk-free rate is 6, so we can say that the expected return on security based on 4 factors of earnings, growth, competition and macroeconomic is nothing but 6 plus 4.11, which is 10.11%. Are we clear? So do you guys understand what we are trying to establish in the multi-factor model? What we are saying in the multi-factor model is that returns are not only based on one kind of risk factor, it is based on multiple risk factors. Okay, we are assigning a beta for each of the risk factor, as well as we are also assigning an expected return that it will bring on the security because of that risk factor. Right? What we have done, we have brought a risk factor, and we have also provided the expected return because of that risk factor. Are we clear, guys? Okay. Okay, let us read what it is saying. This model states that the expected excess return on asset I is the sum of each of the risk factor sensitivity or factor loading of the asset I multiplied by the expected value of the factor for the period. This is exactly of what we have established, that your risk premium is nothing but the factor sensitivity. What is factor sensitivity, guys? What is factor sensitivity? We have seen it in the beta class. Guys, we have seen it in the beta class. Sensitivity is nothing but beta, okay, factor sensitivity, which is beta, multiplied by the expected returns that the factor sensitivity is bringing. Guys, are we clear? Okay. The last thing that we will study today is the single index model. What is a single index model? It is saying that the expected excess return, that is return above the risk free return. What is it? This is nothing but what we have stated, risk premium. Okay, expected excess return is the product of the factor weights of factor sensitivity, beta I. So we know what is beta today, and the risk factor, which is in the model, is the excess return of the market portfolio or the market index. So basically what it is saying is that over here your risk premium is nothing but based on the market. So it is saying that the returns that you are making will be dependent upon the market returns. Guys, see what is mentioned over here. In single index model, it is saying, see, first of all, the word is single. Okay, so it clearly indicates that it is not a multi-factor model, not a multi-factor model, correct? Which means it will assume, sorry, which means it will assume that there is only one factor or risk influencing the return. Okay, and what is that factor? That factor is market. Are we clear? What it is saying, that your risk premium is not based on multiple factors. Your risk premium is based on the market factors. Okay, so basically the way market will move, your stocks will be dependent on it. Guys, over here if you look at it, this formula, expected return of security I minus RF is equals to nothing but expected return of market minus RF into sigma I by sigma M. Do you remember something? Let us take a look back at the explanation which we have seen. See, we have done this in the capital market line. Exactly same formula. Exactly same, but what has been done? This RF has come from RHS to LHS. Guys, the formula is exactly the same. See what is mentioned over here. Guys, what it is mentioned over here, expected return on the security minus the risk-free factor is nothing but expected return of the market minus risk-free return into sigma I by sigma M. Guys, what it is saying is that expected return on security minus RF is nothing but sigma I sigma M into expected market return minus RF. See, if you remember my example of, uh, traveling from point 0 to point RF to point RP and then point RM. If you remember the time, if you remember the line that we have drawn, 0, RF, RP, RM, where we had to travel from 0 to RP. But what we were doing is that we were breaking this road into two parts. First, we were traveling from 0 to RF, and then we were traveling from RF to RP. In order to be able to travel from RF to RP, we took the road from RF to RM and then broke it over here. Guys, do you remember that example? If you do not, I would suggest please look at the first class of portfolio risk and return. That was a very good example and a detailed example. So we cannot repeat it over here again. Okay. Additionally, what it is saying that rather than this term, rather than sigma I by sigma m, what I can use is beta I. Why beta I? If you remember from our previous class, beta is nothing. It is a measure of sensitivity of security return to the market return. Okay. Okay, guys. Similarly, when we are doing sigma I by sigma m, what is sigma m? Sigma m is itself variability in market, and sigma is nothing but variability of security return. So sigma I by sigma m is in a way also showing the sensitivity of the return with respect to the market, but the better measure over here is beta. So rather than using sigma I by sigma m, single index model also advocates for beta. So either of the formula can be used over here. Guys, are we clear? Guys, is this thing making sense? So with this, guys, what we have done, we have understood three return models. One was the return generating model. In the return generating model, what we were saying that returns are primarily based on certain factors. They can be macroeconomic, fundamental and statistical. No mathematical thing over here, no in detail discussion. Second was multifactor model. In multifactor model, we are saying that returns of a security are not only based on just one specific or isolated risk, it is based on multiple risk factor. It can be growth, it can be earnings, it can be sales, it can be competition, it can be microeconomics, it can be geopolitics, anything. In a multi-factor model, what are we doing? We are assigning betas or the numeric value of sensitivity of that risk, and also we are assigning the returns that are generated because of taking those risks. When we are multiplying them and adding it, we are getting a risk premium. When we add it with the risk-free return, we get the expected return on the security. In a single index model, it is very clear that there are no multiple factors. There is only one factor which will impact my security return. That is the market. Okay. Over here, the first formula is similar to the capital market line. Okay. In the second formula, rather than doing sigma I by sigma B, we are doing beta. Why beta? Because it is a clear cut measure of, sensitivity of the security return with the market. Are we clear, guys? So till now we have done three return models. In the next class, guys, we will do two important topics: capital asset pricing model and security market line. Okay, guys, these two topics will be very important. Till then, happy studying.